All right. So today we're going to talk about some investing, and then at the end we're going to talk about the project. As you notice, the homework's kind of tapered off a bit because you should be starting to work on your project. In that regard, I've had a student or two already hand in a draft of the paper, and you know, that's kind of the way to do it if you want to make sure that you get a good grade. It's not a big deal. I can just look through it, and mainly, you really can't tell your story unless you have the page minimum, the four or five. But other than that, the format is kind of up to you, and the project is meant to be partially to fulfill the requirements to get your grade, but the other part is to kind of come up with a plan for sort of your financial life. Again, I don't need your personal details. I don't want anything confidential or any of that kind of stuff. But the more closely you make the sort of forecasted person in your scenario to your situation, the more useful it'll be. I get it. Most people don't know what they're doing next week versus what they're doing 5 years from now. But just take kind of a wag at it. You come up with a plan, and it then you change the plan as you kind of go through life, and that's much better than not having a plan at all. To delay planning or not plan at all because of the uncertainty, it doesn't work. I can tell you, from a military perspective, it's far easier to modify a plan than to make one up when your helmet's on fire. I mean, you see people crumble who try to do it at the last minute and think they're just going to wing it. Finances, obviously, it's not going to come that fast, but man, there's some opportunities out there, even in a market like this. And if you have got your finances kind of squared away and you're able to jump in and take advantage of things now and again, and I'm not saying rampant speculation and stuff, but it is there are certain opportunities that do arise if you have your ducks lined up and you've got some confidence and some money set aside and have been analyzing situations. So anyway, enough on that. We're going to talk about stocks, which is actually kind of fun. Stocks. We'll talk about bonds also. I'm not nearly as thrilled with bonds. I've barely ever invested in bonds. Anyway, the difference between a stock and a bond, as I mentioned before, a stock is actually an equity position. You own a portion of a company. As a bond bonds can be used not only by corporations, corporate bonds, obviously, but also municipalities, states, whoever, even feds. Different reasons people get involved in that. Broadly, stocks are viewed as probably more aggressive than bonds. Bonds are actually a loan. They will pay you back on a certain basis and all the rest of that. We'll go through the details. But a stock, it depends on the health of the company. And it's, they can be super risky if you go with super risky companies, but they can be super stable if you go with old established blue chip type companies that have been around forever and are expected to do well. Although sometimes things change, old established companies do fail now and again. So you got to be careful, but your alternatives, the stock market gets you about 10%, which is a gross exaggeration, but it's been true for about 100 years now. Will you get 10% every year? No. Some years you'll get more, some years you get less, and it averages out. 10% is still pretty optimistic, but to tell you the truth, it's do your own research, but the numbers are pretty much there. Now you will see people say, oh, they're getting a percent or two a day. That's now again, your generation's going to be overwhelmed with, well, I don't know. I guess it's just the media that's changed. The people that are out there to scam you have always been out there. But now they just have maybe a little bit better access or can polish things a little bit quicker and get them to you. But anyway, we'll talk about stocks here. So stock exchanges. So I don't care too much about, where I purchase the stocks. As I mentioned before, any type of stock you buy is just about always going to be on the secondary market, meaning you're not buying some original issue from the company. If you're buying Ford Motor stock, you're not generally going to Ford to buy the stock. Ford's not issuing it as some new sale. No, it's typically coming from somebody else who had these shares out there. New York Stock Exchange, the big floor traders, all that stuff, the people yelling out orders. Yeah, that was kind of back in the day. Now things need to be quicker. That there's so much in the way of technology and just the speed of light in terms of literally people will pay to have computer access with a closer access to maybe the central hub, which still for most of these things is at the stock exchange, but they don't necessarily want the floor trader with the physical presence. They want the short run of the computer cable to that exchange. So it's kind of crazy. There's a lot of things that have gone on, and you've heard all of the hype regarding AI. AI is more of it's just it's just an iterative process where things have changed just gradually over time, and maybe we'll get more automated. But automated trading strategies have been out there for a long time, and they just get more sophisticated and quicker, and people will come up with different tactics to take advantage of some of the gaps. But anyway, different people out there, the specialists and stuff, and this will all be kind of transparent to you. When I submit a trade to buy some stock, do I care what exchange it's going through? Typically not. Do I even know? Typically not. Most of the stuff I buy is through. I tend to invest more in the NASDAQ in the tech sector, so it's more of an automated exchange anyway. It doesn't have this big floor presence, but that's how they established. It's kind of a neat history, but for what we're talking about, all you care is that you purchase the stock and the trade gets executed and the fees are minimal, and so that's where the technology goes. So this is what they're talking about here: OTC, Electronic Communications Network, and less stringent listing requirements for NSE. There is some prestige to be listed on the New York Stock Exchange. It might represent a company that's maybe more established. You're not going to find penny stocks on the New York, but again, you're not going to find the booming companies. But as I mentioned before, just because something's a startup, 9 out of 10 startups in the tech sector fail. So you don't want to invest in a single company. I mean, if you could have picked out the Google, the Amazon, the Apple, in their infancy, that would have been pretty amazing. But you probably would have picked out a lot of other companies that have gone bust. So when you do get one of those companies and you do have an investment in it, you need to sort of let it run. You need to maximize that profit on that individual company, because you're going to get clobbered on the other ones. The other one's going to go to zero, and the other one, may go whatever thousands of percent. Now, again, what I'm describing here is, again, getting into the speculation. A lot of times you don't need to, nor do you want to, get involved in those, small startup type companies. You would maybe want to go with more established companies and also buy your stock, not as individual units, but buy them through a mutual fund. So you've got a couple layers there. If you're buying a mutual fund is typically a collection of stocks. It can be comprised of different elements, different asset groups. But let's say a stock type mutual fund, they'll buy a range of stocks, so that gives you some diversification. And when I say there's a fund manager who's kind of responsible for picking and choosing and making buy-sell decisions. So again, you get some expertise there, hopefully, if they're worth their their salary, and then also you get some diversification. So probably a little bit better and definitely recommended way to do it. And then electronic communications network. After hours trading does happen, but I'll show you a kind of a sample of what you do, and it's just gotten so much easier and so much. Used to buy mutual funds just because that process has always been very easy. You know, in the day you typically place the orders over the phone or some sort of phone system. Now, most anybody will do it from a desktop or from a phone or whatever. But this notion of having to buy in certain units and have a broker, have a person in the loop, and all that stuff is kind of gone by the wayside. So anyway, quotations now, it used to be a big deal. I mean, you used to have to look at, I remember being in the Middle East trying to get quotations. I have to go down to this big hotel in the center of whatever town it was, and Riyadh or down Bahrain, whatever, and it was complete hassle, and the information was days old. There used to be a huge advantage for people actually involved in the market because they would have a ticker tape or some sort of remote thing on their desk. They still have Bloomberg terminals, which provide more information than most retail people have available, but man, you can get a lot on a desktop, and especially if you have one of these subscription services, if you're really into it, you can get information where there's not much of a gap between what you have and what the big boys have. So, but anyway, a stock price is just where it's going up and down, and you can perhaps do some rough technical analysis. There's two types of analysis: technical and fundamental. Two primary. And technical would be involved on, looking at charts and seeing how patterns are. The thing that drives technical analysis is really the psychology. There's no magic to it. The reason the charts move the way they do is because people move the way they do. So anyway, we'll talk more about that. Fundamental would be more on, I like this company, I like their product, their financials are good, they should do well. And so I'm more of a fundamental kind of person, but there's a lot of technical people out there. So back in the day, they used to do sort of tab data, tabular data, not a whole lot of charts, not a whole lot of utility to it. But anyway, the high and the low, over a year, the stock, whether they're paying a dividend or not, dividend yield. Again, yield and dividends, those are associated with obviously income stocks that pay a dividend. Most of your growth stocks don't pay a dividend. They return, or they use whatever profits they have to expand the company. PE, price to earning ratio. Again, these valuations, I generally will. You have to kind of compare apples to apples. You have to look at how other companies in that field, what their price to earning ratios are. Different sectors will have different norms. Volume, VOL, is very important. But again, I'd much prefer to see this in a graph so I can see the comparison day to day rather than just a snapshot. And then the closing price and what the net change was for the day. All right, so that tab data, like I say, it's kind of outdated, obsolete. This is modern charting. Again, I'm not paying for this. This is just off of Yahoo, for example. What we're looking at here is NVIDIA. So NVDA would be the ticker symbol. Pretty fantastic company. I've owned it for quite a long time. They have done real well. In fact, maybe they're doing too well. I would not be buying NVIDIA right now just based upon the price. But if you bought it back down in the day, Here's the charting data. Let's see what snapshot we're looking at. Let's look at 5 years worth of data. So let's say you bought it back here in 2019 and you paid $43 a share for it. You can look, you can see what the charting's going on, and then obviously they had a big push from some of the Bitcoin miners were using their equipment, and now the latest thing is the AI, and now it's just going nuts. NVIDIA is a great company, but it's also that a lot of the other companies aren't doing so well, and so people tend to throw their money at certain companies to concentrate it. But these spikes you're looking at across the bottom are the volume, and the price you're looking at here is the actual price. These are the time frames: 1 day, 5 day, 1 month, 3 month, year to date, maximum. Let's look at the max. So, I mean, way back when. Oh, wait a minute. 2003, yeah. So, it's trading for a couple bucks. Yikes. I didn't get into it quite then. This is what, 2018? Yeah, 2000. Anyway, you can look in there and see all kinds of information. You can customize it. You can do all kinds of stuff. Again, you could go to Google Charts. You could go to some other chart. That actual price information's right here. There's just so much information you can get on this as compared to that kind of almost silly tab data we were looking at. Alrighty. So, in order to buy stocks, you don't need to use a broker anymore. You could, but generally most people would prefer to do it themselves. It's kind of like using a travel agent to book tickets. Most people just go to the site, and book it. And it's sort of the same thing with stocks. You can go to individual brokerage, but I guess you could go to, something like Robinhood or something like that. There's all sorts of different services that have popped up. The one problem with some of these services, but not to say these guys wouldn't take your commission and also front run your trade. They do both. So anyway, when you are getting free trades, they're not necessarily doing it out of the kindness of their heart. They do make a little bit of money, and one of those things is called front running the trades, and so they will share your trade information with larger firms to let them know that orders incoming, and it's kind of a not quite so honest here where the price may actually get boosted because they know having access to that information. And again, when we're talking the milliseconds and below, when they know a trade is coming, they can front run that trade, and the price that you buy may actually be boosted just ever so slightly in the part of that. The broker, I've had horrible experiences with these folks. I had to use them back in the day, and just about every time I relied on them for advice, it was followed up about 6 months later with a notice of a class action lawsuit from other people who invested with this company that they recommended, saying that they actually had a position with that company, the broker did, and that they had misrepresented it, and they were actually pushing companies that they had a position in. And anyway, they were more salespeople than technical help. Anyway, if you are going to get advice from somebody in any sort of financial type things, you want to pretty much make sure they're not on commission, that they have a fiduciary interest, that they're only advising you. Now, obviously, if they're going to make money, you're going to have to, pay for services here. But if you're getting something for free, you're probably not getting something for free. You're probably getting some advice that's a little tainted. Sometimes they just want to churn. Sometimes they want you to buy and sell, which just generates commissions, and you go in and out of positions, and not always the best. So Anyway, but yeah, the days of the old school brokers have kind of passed along. So discount brokerages, yeah, if you're paying a commission anymore, that's definitely not the norm. And full service, I was getting service, but it certainly wasn't in my favor. So, having somebody to, again, it's like a travel agent, calling somebody and having them type in the numbers versus me typing the numbers, I prefer to do by myself. And I think just about anybody can handle that. Placing an order, yep, you're going to come up with a ticker symbol, buy or sell, number of shares, and the whole odd lot thing is kind of silly. It doesn't matter really anymore because it's all automated. You're not creating a whole lot of math for a person who has to do it. The computer doesn't care. It will buy the amount you generally want, so not such a big deal. Where you really want to be spending your time is selecting that stock, figuring out which one you want to buy if you're going to go the individual stock route. Or if you're going to go the mutual fund, you still need to do some due diligence to align yourself with a firm or a fund that matches your requirements and also is more or less proven. And again, you can look at third-party evaluations. If you're looking at mutual funds, you can look at Morningstar. If you're looking at individual stocks, I usually use three factors. Number one, I generally like to know about the company and know about their product. And then number two, maybe some sort of third-party recommendation. And then three would be actually looking at the numbers and comparing it to others in the sector. If you don't want to do that, you can rely more on the other recommendations. But I had a conversation. It's kind of funny. A gentleman called me up from one of the big firms, and again, they were not trying to sell me anything. They weren't on commission, but they said, "Oh, you've got an account with us," and put me in a certain category because of the amount of money I had invested with them. And they said, "Oh, we offered free advice." And the person who called me, I mean, whatever. His expertise was not what I would have expected, and his recommendations were almost kind of insulting. What the person said was, I had NVIDIA, and he said, "Wow, you really lucked out on that one. You did well. That company took off." And I didn't just randomly pull out a dartboard and decide to invest in NVIDIA. Number one, I knew NVIDIA's products way back when with graphic cards, doing a lot of video processing and stuff like that, things that put high demand on processors. NVIDIA, I always thought were the best. So I invested in it primarily for that reason. So it wasn't just pure dumb luck. And then the company, they've kind of moved from strength to strength. Another one he complimented me on was Tractor Supply. And he said, "Oh, is that the same Tractor Supply that I shop at?" Because he was down in the lower 48 somewhere. And, I mean, of course it's the same Tractor Supply you shop at. And oh, by the way, why do you shop there? Because it's a pretty good store in that sector and maybe makes a good product. I mean, I did really well. I don't have any current holdings in it, but Lululemon, just being a new professor, I don't know, 10 years ago, I noticed, also having daughters, Lululemon was good quality stuff, maybe a little pricey, but very popular, and I did real well with that company. And so that's sort of fundamental analysis. And you buy stock, the price that a stock is set at, like, say, let's look at NVIDIA, it's 957. That's a forward-looking price. The investors who are investing in that, they don't set that price necessarily on where the company is exactly today. They factor in the expectation of where the company's going. So they expect it to go even higher. And so that's what you're buying into. And anyway, this was a screenshot of, this is actually off of Fidelity, but I was just going to show you just how easy it is. You type in the ticker symbol, so I typed in NVDA, or you can type in the whole name. It's smart enough to figure it out, get you to the right thing, and then it asks you whether you want to buy or sell. You've got the two buttons. You've already got the money deposited. You can look at how it's doing today. They've got a recommendation, perhaps by, again, not by them. Some of the news that might be affecting it. Other things going on. Boeing's having a terrible time. Anyway, other things going on in the general market. I could expand this chart. I could get to that chart like we had on the Yahoo one. I could look at a broader range. I could go down into research and see what their people think about it and what other companies think about it. So anyway, now I'm in a position to buy or sell. In this case, since I've already have NVIDIA, I tick the sell block, and this is how it's going to work. I mean, all I'd have to do is hit this button here, preview the order, and then it would go ahead and do it. So I tell it I want to sell, the quantity, it's even got a calculator function in here, the order type, which I'll talk about in a second, and if I'm doing some sort of special order type thing, it'll ask me how long do you want to have this order out there if it's not filled. And so the options here, if I click this, it would have either day, which it defaults to. If I click it again, it'll say GTC, or it'll just say the word spelled out, good till canceled, which means it's an open order. And if it doesn't fill today, next section. I have had orders where I put it in and I'll have it GTC and 90 days will go by and maybe they'll cancel it. Maybe they'll send me an email and say, hey, we're about to cancel this order. So anyway, this is some of the automated type things, and it's not really, AI, but when they talk about automated trading, computer trading, and this is available to anybody. This, there's not a lot of computing power being used here, but there's some pretty powerful strategies that you can execute just through the simple trading menu. So if I want to buy it, and I want to buy it at $9.55 or close to that price, I just hit market. Boom, the order's going to execute. If I want to do a limit order, say it's jumping around in this range, it's going from $9.50, down to $9.75. Here again, I'm selling, so I want to get the maximum price. So I may put a limit price of say $9.60 or something like that, meaning it's not the order will not be issued until the price hits $9.60, and then my conditional type order will become a market order, and so the market order will be entered at the $9.60 price, and that's all in the timing, but I should get pretty close to that price, especially on a stock that's got a lot of volume to it. Now down in here are the more interesting type things. Let's say I still have faith in this company. I think they're doing well, and I expect them to go higher, but they've had a pretty meteoric rise, and if they drop, I don't want to see all my profits go away. So I can do a stop loss, a stop limit, trailing stop. And so I printed out there's a help thing, and I hit that, and sure enough, it gave me all the different definitions. So market, we know what that is. Maximum price you're willing to pay, or minimum price you're willing to sell at. Pretty straightforward. Now we start getting a stop loss. Triggers a market order when the price you've set is reached. So what happens is, let's say I don't want to have my stop too close, so maybe I'd put a stop at maybe $915 or something like that. I don't want to sell at $915. I want the price to keep going up. But if it drops below $9.15, it's probably going to continue to drop, is my feeling, and so I want to be stopped out. Stop limit, anyway, to help manage your personal gains, security price declines. Now you can also do trailing stops. These are kind of interesting. So what you can do here is, let's say the price is at $9.55, like we said. We set the stop at $9.15, so we put in a dollar amount. We could also do it, say, if the stock drops by 10%, which would be even lower. Anyway, the stop is established below that price. So if the price, let's say I do the trailing stop at 9.15, which would be about what, $40 behind. So I'd probably put in a $40 type thing. If the stock price descends by more than $40, trade is executed. But let's say the price goes up. The price goes up to $1,000 today. My trailing stop, it's a trailing stop, right? So it's going to trail behind in the price. And so my trailing stop for, the next day or whenever would be established at $960. And as long as the price keeps going up, my trailing stop keeps trailing. It keeps following behind it. So kind of a cool strategy. Let's say the price goes up to $1,100. Now my trailing stop, it's at what, 1060, 1,060. Or maybe if I use that percent, the 10%, the trailing stop would be, basically $95 below, and it would ease up below it. So I can kind of sort of go on vacation here, and knowing that if I've got a trailing stop in there, it's going to just follow right along, and I can be confident that if the price starts to descend rapidly, I'm going to be stopped out of the market, and my shares are going to be sold, and I'm going to lock in some profit. It all sounds great. One of the problems, though, is certain times in the market, things are quite volatile, and so stock prices will bump around, and that's why you wouldn't want to set the stop too close. The science of where to set that stop, it depends on many factors, because the beta, the volatility of this underlying stock is going to affect it. And, you could misuse this and incrementally keep losing if you rebought at that other price. If it just bumps down there, hits your stop, and then continues on up to $1,000, you're not going to be happy. So there's options in there, but a lot more than what the slides and what the book are telling you can be done. Okay, so here's kind of an explanation of those things again. Market order, so buy, sell right now, limit, buy, sell, and then the stop orders, specified limit. Okay, so you can have regular stops, and then you can have the trailing stops. Yep. And so it's quite easy, they're dealing with your money. So most of the help things on here are pretty straightforward. They're pretty in depth, quite useful. I mean, it gets to the point now with a lot of people say Robinhood, where they've kind of gamified it with the confetti and all, where they, make it seem like you're just playing and you're winning a video game. It's not that, but they it is quite easy to do, and actually it's kind of fun. You get your little dopamine hits. They've got it wired to encourage you to want to trade, which again may be a little too far the wrong direction. It went from being very difficult to now where it's a game. Buying stock on margin, you will get wrecked. Wrecked is whatever, that's more of a crypto term, but when you buy investments, any investment using borrowed money, it's pretty aggressive. With real estate, it's just the way things are done. Real estate is such a stable asset, and again, it depends on the real estate, where you're buying it and what type of real estate it is. But for the most part, compared to the stock market, real estate is very stable. And so it's not uncommon. In fact, it's typical to use borrowed money to buy real estate. But in the stock market, oof, and in the crypto market, it's deadly. So there are people, again, you'll see people online, they max out their credit cards, they get a bunch of cash, and they go into the market and they, you know, tout how much money they've made. Keep in mind that for every one of those people who's talking about how much money they're made, there's hundreds who obviously don't want to share their misery that they got cleaned out by using borrowed money. So again, you know, Federal Reserve, yeah, we've all got VPNs. We can all trade on overseas accounts. We can use more margin. The problem with this too, with most accounts, most of these accounts, like say Robinhood or something like that, if you lose money, you can only get to a certain level before they stop you out. If you're actually doing it in the market, you know, with an account where you've got a lot of assets tied up, oh, you can lose money that you don't even have. I mean, you can end up massively in debt. So be very careful with margin, and it'll also be called leverage, whatever, 10x, 50x. They don't let you do that in the U.S. markets, but some of the foreign markets that you can access if you've got a little bit of, you know, computer knowledge can really get you into trouble. Because what happens here is you've got a thing called a margin call. So let's say you max out your margin. You are buying some NVIDIA stock, and you know you buy whatever $1,000 worth of stock, but you buy 50% on margin, meaning that you only put up 500 and the other part is on margin. Well, it's all good if the stock goes up, but if the stock price goes down, say the stock price goes from, you know, nearly 1,000 down to 400, well, you're going to get a margin call. You're going to get if you've got it maxed out like that, you're going to get a call from the broker, or the computer's just going to process it and say, hey, you need to deposit more funds in this account, or we're going to sell your shares. Because in the margin call, your margin is the underlying asset. What you have to secure this 50% is the value of that stock. So that stock that was worth $500, if that stock price, because the overall stock went down by 10%, all of a sudden your margins down to 40%, and you need to put in more cash to get it back up to that limit. If you can't get up to that limit, then they sell, and it's a forced sale, and you're getting out basically at the bottom. You know, it'll descend to a certain level, and so the whole notion of, you know, buy low, sell high, you bought high, and now you're getting stopped out at the bottom. So a margin call means that they need more money to get you back up to the 50% level. You either put up that money or you're sold. If you're just a regular investor who's using, you know, funds that are available, cash, you can have that stock price go down. You probably should get out voluntarily, but if you don't, at least you're not going to get stopped out. Anyway, short selling a stock, this gets kind of involved. This is big. If you follow GameStop, and there's some movies on this that are kind of interesting, actually really interesting. The Big Short is a great movie. Then there's I think it's called I can't remember the GameStop movie that came out just a year or two ago. But anyway, when you're short selling, you're thinking that the stock price of a certain company is going to go down. Okay, and so what you can do in a short sale type situation is you can sell stock now and then purchase those shares later. So let's say you expect NVIDIA to drop, and so again it's going for nearly $1,000. So you go ahead and sell these shares at the current price, say $1,000, and then you're going to purchase those shares at a later date, right? So let's say you short sell, so you sell these shares for $1,000 today, and then you're going to purchase these shares back, to fulfill that order, to make good on this. You promise to do that, say 1 month from now, and you're hoping that by the time you go to purchase those shares, that the price will have dropped. So, you sell 10 shares at $1,000, you get $10,000 now, and then you're hoping that a month from now, when you go to purchase those shares, they're going to be trading for say 800. So you'll spend $8,000 and you'll net $2,000 worth of profit. So there's a lot of moving parts. There's obviously people aren't going to do that whole shorting process for free, so there's going to be fees involved in that, and you have to have somebody on this side of the market who's going to allow you to do the short selling thing. So another investor, and this is the key part for me why I don't typically do short selling, is that somebody else on the other side of this trade completely disagrees with me. They want to take my bet because they feel that the price is going to go up, that I don't know what I'm doing, and they're anticipating that they're going to make some money off of me because I'm going to have to buy it back at a higher price. If the price goes up to, 1,500, I still have to buy my 10 shares. So I'm now down, a fair amount of money. In the GameStop situation, back when they had the meme stops, you had GameStop and you had AMC Theaters and all the rest of that. I was involved in that stuff slightly, and as the stock price started ripping up, going up exponentially, parabolically, the people who had to cover their shorts, who had to buy that stock, they got wiped out. Now, there's a lot more to it. It wasn't a huge victory by all the retail investors because, again, the smart financial people, they saw what was going on, and they really made a lot of money on this as well. But in the movie, it makes it look like the little guy won out. Maybe not, but interesting movies. I'll put links into the video because we'd spend a lot more time on that. For the most part, though, short selling, futures, options, all this other stuff, you really don't need to go there. That's getting into speculation. You can do just fine by picking good companies, and in the long haul, you'll probably do much, much better. Technical analysis and fundamental analysis. So I touched on this before. Technical analysis, you look at the price patterns on the charts, and those price patterns, again, it does get quite technical where they'll review the patterns and they'll describe the patterns. But keep in mind that these patterns are generated by the psychology of the people who are executing the trades, that humans tend to do certain things when they're buying and selling, and so it generates semi-predictable patterns. But a true, somebody's doing pure technical analysis, they don't even know maybe what the company's selling. They don't know what the current market conditions are right now. They just know what the charts are showing them. And so they could be off in a closet somewhere just with chart data and making expectations. The problem with technical analysis of late is that, you and I think, oh, we can look at a chart and we can see patterns and we can do all this stuff. Well, guess what? There's some very smart people, coming out of the mathematics and the physics and all these different, high-powered fields, and they've sort of automated this, and this is where AI and other programming comes into place, where they can come up with programs that can do this analysis far quicker and better than a human. And some of the things that used to work in technical analysis, some of the strategies no longer work because the computer software can act quicker than a human, and they're on these situations before you and I as an investor even recognize them, because again, they've just put their knowledge and translated that into software and have that software out there running that's continually analyzing and looking for trends and just hammering on technical analysis. Fundamental analysis, though, on the other hand, that's looking at the value of stock, the products, the earnings, all the rest of that. And I've done semi well on this stuff also because in the tech sector, there's some of these earnings and other things that just don't equate. And so you almost end up with a bit of an advantage as a consumer or as somebody who can maybe evaluate the implications of certain technologies, where some of these old school Warren Buffett guys may not be in tune with, cultural trends and may not, may not know Lululemon from whatever, but they know railroads. I wouldn't want to, try and outguess somebody like Warren Buffett in regards to that. But in terms of technology, I think, most of you could hold your own in terms of identifying what's going to be the next big consumer item and maybe do well in that sort of analysis. All right, financial condition. All this stuff's available. Do I have the skills where I think I'm going to be able to compete against, a Wall Street firm with a office full of, economists who do nothing but this all day? Probably not. But I can certainly read those analysts' reports, and I can compare, companies in the same field, one against the other. So I'm not going to tell you that I, dig into these companies' financial statements, but I will look at it, analysis, an analyst review of those financial statements, certainly. So, again, stock prices are forward-looking, right? So, strong sales, investors are confident, price goes up, more demand. It's all supply and demand, right? And that's where sometimes some of those news things, again, if you're looking at a ticker symbol and you just look at tab data, you're not getting a lot of that information anymore. Any of those chart type programs, when you see that data, it'll be accompanied with, a news story that perhaps led to that change. Accounting fraud, yeah, there's always going to be fraud going on. These things are getting a little old. Enron, WorldCom, Bernie Madoff, Ponzi schemes. There's nothing new. The news will always try to make it sound like it's worse than it ever was, but this stuff has gone on forever. There is some, better strategy is maybe stick with companies that are only listed on the major exchanges, or at least have access to the exchanges, because you definitely want them coming under the SEC, the Securities and Exchange Compliance requirements. Small, penny stocks, very small stocks, may not be publicly traded, and you'll see a lot more fraud going on in that, or certain segments. I mean, like Canada, for example. You think Canada is a very normal, there's no fraud going. The Canadian stock market, especially due to the mining stocks, is the Wild West. It is just crazy. I don't trade in the Canadian stock market. By the way, if you want to buy foreign companies, generally do that through a U.S. exchange or whatever country you're a resident of. You can buy companies, foreign companies, but if you buy them on foreign exchanges, you're going to generate a lot more problems than it's probably worth in terms of currency fluctuations, in terms of compliance. You can buy foreign companies through their representations on the U.S. markets if that's what you choose to do. Analyzing stocks, GDP. Now we're getting into macro type stuff. Fiscal policy. Unfortunately, the governments and the interest rates and all that, their tax strategies, huge implications. You'll see, the forecast for rate cuts that came out this last week has a huge effect on the market. So it's unfortunate. Maybe we'll get to a point where, and that's philosophically, I'd like to make money on crypto coins, but Bitcoin specifically, if it can sort of get some of the role of government and meddling out of the way by virtue of being, independent, that is probably a good thing. Companies now, our countries are so interlinked. It used to be, when the U.S., gets a cold, the rest of the world sneezes or whatever the things were. But yeah, markets are pretty well linked. If one market is down globally, you're going to find most of the markets down. Interest rates. So certain sectors are very reliant on low interest rates. Again, the tech sector, very interest rate sensitive. When rates were low, things were booming. As rates start to go up, investment slows, stock prices go down because there's less supply and demand. So during COVID, as we know, things went crazy. A lot of money printed, lots of money still being printed. So this year's going to be fine. An election year, they generally won't let bad things happen. But who knows for the years coming up. And inflation, always a factor, It'd be great to make 10% in the stock market, but it's not so great when you're only left over with a net of a couple percent because inflation was, 6 or 8 or whatever it is. So it definitely affects your stock market performance. Conditions in the industry and the overall economy. So again, you're not alone out there. I mean, if you are going to jump in and do, try and buy individual stocks, the tools that are arguably as good as what the professionals have at the retail level now, the tools you have available to you are comparable almost, and sometimes your insight into the consumer things is sometimes superior than some guy sitting back in New York. So again, a lot of factors influencing stock price. Some macro factors, and then some just involved with the strength of the company. This has just been a strange year, where you have a certain number of companies, that the Magnificent Seven they call them, doing super well, and other companies just kind of going sideways. So no telling what's going to happen in the upcoming years, but again, your alternatives for investing are not great either. Limitation of stock analysis. Yep. People always will get things wrong. They'll talk about, these guys who have predicted the downfall of the economy. They've successfully predicted, 15 of the past 2 recessions, meaning that these guys predict that recession's always going to happen, and once in a while they're right and they claim victory. Well, they don't talk about the times where they claimed the stock market was going to fall apart and things roared upwards. So very difficult. Bonds. So bonds, again, are a loan from a company. Companies, when they want to invest, they don't go to the bank generally to get a loan. They go to the big commercial bank to organize a bond sale. And that bank, rather than loan out their money, will arrange a bond sale to get you to invest. Say you invest like 20 grand, and that money's loaned out to that company, and that company in exchange for that will pay you a dividend, quarterly, annually, whatever, and then at the end of the term of the bond, they'll give you your money back. So, again, maybe 10 years from now, you gave them $20,000 now, they give you payments in between now and then, and at the end of the term, they give you your money back. So That par value is that amount of that bond and bond maturities. But yeah, most bond. There's also short-term bonds. There's even longer-term bonds. Well, 30 years is pretty long, but I've been involved in bonds, but on a short-term basis. They make the interest payments and then they give you the money back. Maybe a call feature. So let's say because of higher interest rates, in order to make bonds attractive, they have to offer a higher interest rate. So let's say they're paying you 8% on your bond right now if you'll buy it today. They're having to do that because interest rates are high and people aren't maybe as interested in doing that. They don't want to tie up their money. So they give you that 8%. Well, let's say 2 years from now, interest rates are down to maybe 4%. Well, that company that is paying you 8%, they don't want to do that anymore. They'd prefer to cancel out your bond and issue some new bonds at that lower rate. So if there's a call feature, they may very well do that. So a call feature is not in your best interest. You as the purchaser of the bond, it means you can only get a so good a deal before they call the bond. Now, in order to get you to take a bond with a call, maybe they'll offer you a little higher return rate to incentivize you. Convertible bonds can change between bond and stock. So, in order to have that convenience, they'll maybe give you a little less return since you've got the benefit of it being convertible. Yep. So what happens with bonds is you can sell these things also. So let's say you have this bond that it's a $20,000 bond. And let's say it's paying an 8% interest rate. That's pretty attractive. A lot of people would want that, especially let's say a couple of years from now, the interest rates go down to only 4%. Well, your bond is actually now worth a little bit more because it's paying a higher rate. So you might be able to sell that bond for $21,000 or something like that, even though you only have $20,000 invested. So it could sell for more than that. Conversely, if interest rates are low and the new bonds being issued are these new 8% bonds, well, your bond's kind of stinky. Nobody really wants it. So if you go to sell it, you may only get 18 grand or whatever for it. So the bond price, you don't have to keep it till the full life. You can sell it in the secondary market, but the price you get for it is going to be based upon the interest rate that it's paying compared to current stuff. And that's summarizing just what we talked about. Yep. T-bills. Okay, so now you're dealing with the U.S. government, right? And theoretically, that presents very little risk, guaranteed by the federal government. Sometimes there's some tax implications that can be, helpful. But anyway, because there's very little risk involved, there's going to be very little interest paid, very little incentive. So they'll make these things attractive enough for certain people to buy, but only just. That's how everything in the investment world works. If somebody is paying you, 15, 20% interest, it's because there's a lot of risk involved there. They would not have to pay, 15, 20% interest. They would not have to incentivize people to buy those things if they were perhaps a better product. So, municipal bonds. So this would be offered by a state or local. Sometimes people will do this to avoid the income tax. So you have to do, just because it's a tax-free municipal bond doesn't mean it's a great deal. You have to look at your tax situation and decide, whether it's a good deal for you or not. And we'll look at a problem regarding that. It's not a hard calculation, but it is a calculation you have to make. Low default risk, interest is taxable on the federal bonds. So again, the federal government's assumed to be the best. Federal government, they can print money. Municipal bonds, local bonds, state, they can't run deficits. So they can and have, in certain cases, rare cases, gone into default, gone out of business, basically. And then corporate bonds, since you're dealing with a company, now you're looking at more risk because they can go out of business. So if you're going to call it a high yield bond, yeah, you're selling it, right? If you're evaluating it and you're being honest about it, you might use the term junk bond. And what that reflects is it's going to pay a pretty good rate, but that's based upon the fact that it may pay a pretty good rate for just a little while before they go into default and quit making the payments. So, risk and reward, they're definitely correlated. How they quote it, the coupon rate, maturity, yield, closing price. Again, bond traders will go into the charts. What happened back in the 2007, 2008, and again, the movie The Big Short is quite good about kind of highlighting this in a informational and entertaining way. But what happened was people sort of lost track of what the assets were. They made a whole bunch of crummy loans to people who had they would call them ninjas, no income, no job, no assets, and yet they're still getting approved for home loans and maybe getting approved for 4 or 5 home loans because they're speculating. They have no way to pay these loans, and if the market turns, they're in super big trouble. Well, it was still viewed as very low risk because real estate only goes up, is what they thought. Well, when real estate quit going up, in fact, because a lot of these loans collapsed, real estate prices started to go down. All of these loans just crumbled. But anyway, they got a lot of these substandard loans, crummy loans. They put them together in a big pile, and they call them collateralized debt obligations or different names. But basically, it's a bunch of subprime loans put in a big pile, and then they said it wasn't just a big pile of crap. No, somehow it was better because they were together. They were stronger, and they were more diversified in terms of their holdings, and oh, by the way, it's real estate and it doesn't go down in value, and so when things started to fall apart, people realized that these things that were sold as low risk debt obligations were really just a bunch of crummy loans all piled together, and it all came apart. Here's a quote for a bond. Again, not quite like stock markets. You can find charts on all this and yield curves and all kinds of different stuff, bond traders and the rest of that. But in terms of retail investors, most retail investors don't do as much in the aggressive bond market the same way they do in the stock market. So I discussed this. If the rates rise, the value of a bond decreases, right? If I can get a new bond right now, go to the, on the market and buy one that's paying 8%, that old bond that I had that's only at 4%, nobody wants it, so the price is going to be down. Implication of taxes. Yeah. So you could pay capital gain if you bought low, sold high, and ordinary income, which means it's just added into your income, which isn't normally great. You'd rather have it handled as long-term income. Valuing a bond. So do a few calculations involved in that. The company may go out of business. The entity may go out of business. Again, people rate bonds. So if something's a junk bond, it's going to be, obviously there's a scale and there's a huge amount of grade inflation. You would think an A is a great bond. Yeah, that's pretty good. Triple A, now that's good. If it's all caps, it's kind of silly. And you get down anything like in the B range, C range, which, from an academic perspective, you think, well, that's a reasonable grade. You're getting down into junk category. So it's very overinflated. But anyway, Moody's, Standard & Poor's, they do the ratings. And they're, outside of the companies. Although in the Big Short, again, you would see that these companies were sort of corrupted. They were part of the process. They were supposed to provide an independent analysis, and they didn't. Yeah. Standard economic conditions. So, yeah, down into BB, you're down into junk. So, AAA, Standard & Poor's does the caps, Moody's does the lowercase, whatever. But if it's in B's, getting very poor. So here, you're probably getting better than 20% for those few months that you actually get those payments, and then they go into default, and then you've got nothing. So. We talked about a call, and we talked about interest rate risk, and this means where the stock or the bond price is going to be affected based upon the competitive interest rates. Sometimes people line these things up. I want to get these dividend payments, then I want that lump sum. I want to get that big chunk of money back at, on retirement day. Or when the kids go to college, whatever you want. Playing the investment on the interest rate expectations. And then also just buy and hold. Yeah, here's matching maturities up to some important date. Okay, so that's kind of stocks and bonds. So this is the term project. Again, this is printed out in your syllabus. The big problem with this is just kind of getting started. Whatever you do, if it meets the page length and it's useful to you, you're kind of 90% there. Most people fail, if they do fail in personal finance, because they don't have a plan. They just kind of bumble through life, and then they get to retirement, and then they look around and they see that their neighbor is retiring and doing big things, and they're still struggling, if not still working. So sometimes, life happens and puts you in that situation, but sometimes your situation was exactly the same as your neighbor's, but because you failed to act, you ended up kind of where you were. So, and you can't, there's the time value of money. You need time for investments to work, to generate wealth. So, being financially literate when you're, 65 is good, but being financially literate when you're in your 20s is exceptional. So you need, everybody ends up pretty smart on financial stuff by the time they hit retirement age. But the people who had that knowledge early and could apply it when it could still help them, that is a huge difference. So, again, it depends on your individual situation. I can't give you a kind of cookie cutter approach because there isn't one. You have to come up with your own situation, what you where you are in life, and what you need, whether you're immersed in your career or whether that's just something you're trying to still figure out. But there are things that you can do now, and you can just, let's say you don't, you got a college major, but you're not even sure if you're going to go in that field. Well, go with what the most likely outcome is, that you are going to do whatever, and just make a forecast and a plan based upon that. You can go into all of those financial brokerage sites primarily and look in their retirement section, look in their wealth building section, and their strategies for saving for college. Tons of information in there. It's all free. You can screenshot it, you can put it together, and you can just sort of go step by step how you're going to do it. You can also look at things like Social Security's in there. Look at the Social Security site. See, based upon if you've been working, what your amount of Social Security benefit would be. And keep in mind that that's your money. You're putting money into Social Security. But by the time, if you're younger, by the time you go to get Social Security, it's probably going to be looked upon as a benefit, as almost a welfare type thing, because they've gotten so far away from the original concept of Social Security, where you put that money in and the government's watching it for you and they're going to give it back to you. Now it's just going into a general fund and it's being spent on all kinds of things. And then you'll put it together in a summary, and it shouldn't be a big problem. But main thing I would do is get started. And like I say, I've already got a couple papers, and if your paper's not quite up to speed, then I'll send it back to you and say, well, you need to add more content on this or more content on that, and in order to get an A. If you want an A on this paper, you can get an A on this paper. It's up to you. I mean, you can send me the thing and make sure that you're sort of pre-approved for an A. So when you send in your final paper, it's not there's no mystery to it. It'll be pre-graded before you've even submitted it. So up to you. All right, that's enough for today, and good luck.